Good morning. Welcome to the Czech National Bank. It's nice to see you there again. I would like to open our traditional session focused on the new macroeconomic forecast. It's my pleasure to introduce you the speakers of today. The Czech National Bank Board is represented by its new member Jan Freit, and the Monetary Department is represented by its Executive Director Petr Král. Please now let's turn our attention to our new Czech National Bank new forecast, and which will be presented by my colleague from the Monetary Department, Karel Musil.
So good morning, ladies and gentlemen, also from my side, and it's my pleasure to present here the new macroeconomic forecast as it was prepared this summer. It's a summer forecast, so we extended also the horizon to cover also 2024 year. And I will briefly go through the assumptions of the forecast, then focus mainly on the new macroeconomic forecast. Then I will compare it to the previous one, and at the end I will present two extra simulations that we prepared for the policymakers to cover the risks that we are facing around the baseline forecast. So let's jump immediately to the assumptions of the baseline scenario. I will start with the external outlook. So it means that in this case, the effective euro area inflationary pressures has been growing. It's quite clear. It's driven by the energy prices, especially the prices of electricity and the gas, contributing importantly not only to the consumer prices but also to the producer prices. Additionally, there is also obvious, quite important contribution of the core component of the producer price index, and it means that indeed this contribution will or has already increased the prices in the eurozone quite significantly. We expect that the situation will improve throughout the rest of this year and during the next year, which means that the PPI dynamics will gradually decline back to the 2% in 2024. This situation naturally put pressure on the budgets of the households, of the companies, which means that this is linked to the subdued economic activity in the second half of this year. And overall, it means that for 2022, for this year, the GDP growth in effective euro area will be about 2%. Once the problems in the global value chain gradually disappear during the next year, the economic recovery appears in the eurozone. To this development and to this outlook, there is also a response of the European Central Bank. So the bank stopped the assets purchasing program, already increased the interest rates, and the market expect that this increase in the interest rates will continue also in the future, which means that the 3 months Euribor will gradually increase and return to the 2%, almost to the 2% at the end of 2024. Another important assumption for the baseline scenario is related to the fiscal policy. So it means it's already the domestic part of the assumptions. And here we can clearly see that there is a slowdown in the growth of the government expenditures for this year. That is related mainly to the end, or in some cases also significant reduction in the expenditures of government that are related to the COVID situation. On top of that, there is also the assumption about the freeze wage growth in the public sector, and also some extra expenditures that are related to the Ukraine refugees. Around this 3.5% that is assumed for this year for the nominal government expenditure growth, that will be quite similar for the next year and also for 2020-24. Indeed, the same factors are contributing also to the fiscal impulse. So we assume that for this year, the fiscal impulse will be slightly negative. Then there is quite a lot of measures, both on the expenditure and revenue sides of the government budget. And these expenditures mainly helping to solve the energy price crisis will then turn the fiscal impulse to be slightly positive, so contributing positively to the GDP growth in 2023. So combining these assumptions, we can proceed with the baseline scenario, and I will start in this case with the forecast of the inflation. As it is obvious, the prices grew quite quickly recently, and the forecast expects that the inflation stays around 20% for the rest of this year, so in the third and fourth quarter of this year. It will be again a combination of the demand and supply pressures that will contribute to this quite high growth of prices. And then once these factors will gradually disappear, also the inflation starts to decline and indeed converge back to the inflation target in the already monetary policy horizon. Here I would like to highlight that the horizon, the monetary policy horizon, is shifted, and in the baseline scenario it's the first half of 2024, so it's shifted by 2 quarters for the future compared to the baseline scenario that we had last time. So it means the horizon covers right now 18 to 24 months ahead. On top of that, the baseline scenario also assumes the anchored inflation expectations at the inflation target of 2%. When we check the monetary policy relevant inflation, it's quite close to the headline inflation, indeed oscillating around that. This is because of a relatively big number of changes in the indirect taxes. And on average, it's quite close. Regarding the changes in the taxation that are influencing the headline inflation or bringing the difference between the headline and monetary policy inflation, it's mainly the change in the excise duties for the tobacco and cigarettes at the beginning of this year, then the excise duties for the diesel and petrol as it was introduced from June to the September for this year. Then there is a kind of a base effect that is related to the change in VAT for the price of electricity at the end of the previous year. And on top of that, there is also the adjustment in the fees for the renewable electricity sources that is influencing the calculation of the monetary policy relevant inflation. When we speak about the headline inflation, and we decompose it to the contribution of its subcomponents, then from the upper picture is quite clear that indeed all the components are contributing to the increase in the inflation, and also to the inflation about 20% in the second half of this year. I would like to highlight here two main components, which is core inflation and the regulated prices inflation. It is clear that the contribution of the core inflation is quite significant. It's obvious from the picture that the core inflation will further accelerate also in the third quarter of this year, and then gradually with the contribution of the previously restrictive monetary policy, it will gradually start to decline. When we check what is behind this further acceleration in the third quarter, indeed it's both tradables and non-tradables components. When we check the non-tradables one, it's important to highlight that there is a quite big contribution of the summer holidays prices, something that is typically entering this period, and together with the high contribution of the inputted rents, the core inflation is increasing. The imputed rents, it reflects the let's say ongoing increase of the prices of the new houses. Indeed, at the beginning of this year, the year-on-year dynamics further increased and reached almost 30%. Then also the other part of the imputed rents, which are the construction work and the price of materials, are also increasing, reflecting the increase in the commodity prices and also the problems in the global value chain that are indeed pushing the prices of construction material up. The second big contribution to the headline inflation is related to the administrative prices. The forecast assumes that they will further increase, and the main drivers behind that are the prices for the gas and electricity for the households that are indeed forming majority of this increase. We assume that the increase will continue until the end of this year, and the growth in year-on-year term reach almost 40%. And once the situation start to improve during the next year, the overall situation on the market will adjust. Then the regulated prices starts to decline and gradually go to the lower numbers. Indeed, for 2024, we still expect that the growth of the regulated prices will be above 5%. So still some pass-through from the relatively high energy prices will continue. For the rest of the components for the headline inflation, it's clear that there is a quite big contribution for the food prices, as we expect that these prices will peak during this summer, reflecting still relatively high agriculture prices or agriculture product prices, together with the increasing costs because of high electricity prices for the food producers. At the same time, the contribution of fuel prices is indeed quite, or there is still existing during this year, and we expect that once there is a correction in the oil prices during the next year, the contribution will gradually disappear. When I'm speaking about the overall inflation and contribution of all these components, we prepared during this forecasting round an extra analysis that is presented in the box that is already available at the web page. When we check what is the position or situation around the Czech inflation in the context of the whole Eurozone, and to give you some pictures from this analysis, I choose these two one. Indeed, the first one is saying that the growth in prices, these are related throughout the whole Europe to some of the subcomponents that are indeed common for these countries. It's clear that the inflation in the European context is driven by the increasing prices of houses, including prices of energies. There is big contribution of the food and beverages, transportation. In case of the Czech Republic, the red square also indicates that there is a big contribution of the clothing and footwear prices. What does it mean? Indeed, by checking this picture, we can conclude that some of these factors that are driving the inflation in the whole Europe, including the Czech Republic, they are not the external one. They have an origin in these economies, and partially they can be considered to be a domestic one. When we check the intensity of the inflation or broad-based increase in the prices, indeed quite interesting is the second picture here, and it captures different measures of the underlying inflation. And what we can see and conclude from this picture that in case of the Czech Republic, indeed, no matter which type of measures we use, whether it's the headline inflation, core inflation, or other different ways, median inflation, trimmed inflation, these measures are quite close to each other, indeed indicating that really the increase in the prices is somehow underlying in our content. When we speak about the intensity or broad-based increase in the prices, it means that in our case, for the domestic economy, it's related indeed for both of the components. What I mean, the growth in costs and also the ongoing or further increase in the profit margins of the companies that is indeed related to the majority of the components within the CPI basket. When we check the cost dynamic for the Czech economy, then it's clear from the picture, the upper picture, that indeed the peak in the growth of the costs is indeed right now. So the acceleration or the growth accelerated, and the main contribution is through the imported prices, and it's related to both of the components, the energy prices, so increase in price of gas, electricity, oil, and also partially because of the increase in core prices. Once the situation will normalize during the rest of the year and during the next year, then the contribution gradually of the imported prices will gradually disappear, and the growth of the total costs will converge back to the equilibrium. For the story, it's also important that there is still quite a significant contribution of the domestic factors, which are the yellow bars here. And we can see indeed the decomposition, which is the lower picture, that there is a kind of small or gradual slowdown in the growth of the domestic factors, which is driven mainly by the dynamics in wages in the market sector. The forecast believes that the growth of domestic costs will be somehow stable for the rest of the year with the stable contribution of the wages. What is interesting is that the price of the capital is indeed anti-inflationary, indicating that the weak demand that will appear or is forecasted for the domestic economy will contribute in the anti-inflationary direction, and contrary to that, the labor efficiency or productivity is contributing to further increase the inflation. Indeed, that's the reflection of the fact that the forecast says there will be some mild recession in the second half of this year, which will somehow change the structure of the domestic costs. Once the situation will improve, there will be, let's say, recovery of the domestic economy that will push for a higher increase or increase in the wages, so the contribution is bigger, and also the price of capital as the demand pressures and the labor efficiency will twist to the opposite contributions, and the growth of the costs will then gradually converge back to the equilibrium. As I said, a quite important factor for the domestic development is the situation on the labor market. Indeed, still we consider the labor market to be overheated after some cooling down after the COVID period. But overall, it means that the overheated labor market will further push for increase in the employment, and also the worsening in the unemployment rate won't be significant, reflecting still the tightness on the labor market. At the same time, the forecast says that the growth of the nominal wages will be somehow muted during the rest of this year. So indeed, we do not expect that there will be some extraordinary indexation of the nominal wages to the development of the prices, to the inflation. Once the situation will improve during the next year, then there will be some room for the higher wage growth in the market sector. This is the nominal development. What is maybe more important is the dynamics of the real wages, or the real volume of the wages and salaries in total. And because of the high inflation, indeed, there will be a significant drop in real wages for this year, partially also for the next year. And as the inflation will decline, then the real wages will gradually start to increase in the second half of the next year and during 2024. Couple of times I mentioned that there will be indeed decline in the economic activity that is for the second half of this year. That's related mainly to the worsened situation of the households, as really the real income of the households is negatively influenced. Then it means that the contribution of the household consumption will be negative to the growth for the rest of this year, and there is, let's say, mild decline in economic activity for the next, or for these 2 quarters that are for the rest of the year. For the next year, we expect that the GDP growth will be about 1%, driven mainly by the improvement in net exports. And indeed, this picture in total means that the overheated economy, let's say measured by the positive output gap that was identified for the first half of this year, will change, and there will be a negative output gap for the second half of this year. And once there is a recovery of the economy during next year, the output gap will gradually decline. So it means that there will be change in the, let's say, inflationary pressures that will be related to the economic activity. To go deeper into the some of the components of GDP, as I said, there is a significant drop in household consumptions that will be negatively influenced by the drop in real incomes for the households, together with the sentiment and also the estimation of already used almost everything from the forced saving. It means that the situation for the household will be negative, and indeed leading to the drop in the real consumption. Once the inflation will decline during the next year, the overall situation for the households will improve, and also there will be an improvement in the consumption. Another important component for the GDP is the gross capital formation, and in this case we can see that indeed the dynamics is heavily influenced by the changes in inventories, which is related to the problems to the problems of the global value change. So once these problems will disappear during, let's say, the second half of the next year and later on, then there is a decline in the inventories, and the investment activity or the business investment overall is quite muted, indeed reflecting the fact that still there is let's say, weak foreign demand for the rest of the year. There is a negative sentiment about the situation in the domestic economy related to the geopolitical situation that we are facing right now. And at the same time, also the relatively high prices of energies are pushing for the costs to increase in case of the companies and preventing from, let's say, big investment activity. These two components of consumption and investment means that the domestic demands will be really subdued over the near-term forecast. Actually, it means that there will be also linked to the decline in the or slower growth of the imports. Overall, in case of the net exports, the contribution will be to the GDP growth will be quite important during the next year when there is a renewal of the foreign demand and let's say improvement in the overall situation. Regarding the exchange rate, indeed the forecast believes that the exchange rate will depreciate during the rest of the year and the beginning of 2023. And the main factors for the depreciation is the worsening of the trade balance or the current account of the BOP. Indeed, negative terms of trade shock that is actually hitting the domestic economy through the higher or increase in the prices of commodities and energies. On top of that, that's the sentiment on the exchange rate market about the regional situation that is related to the Ukraine, and also there is a contribution of the narrowing of the interest rate differential as the domestic interest rates are declining during 2023, and the Eurozone interest rates, the ECB rates are increasing. So having this impact on the exchange rate. Again, once the situation is improved, the problems with the global value change, improvement in terms of trade, will appear during 2024. There is a pressure for correction and mild appreciation of the exchange rate. And in case of the interest rates, there is let's say broad stability for the interest rates for the rest of the year. It's the response to the still strong inflationary pressures that are present in the domestic economy, and then once the inflation will decline and return back to the inflation target over the monetary policy horizon, the interest rates will decline gradually also back to the equilibrium. As I said previously, this baseline scenario indeed use the monetary policy horizon that is the first half of 2024. So the response of the interest rates is really a response to bring the inflation back to the target at this horizon. So shifted to 2 quarters for the future compared to the baseline scenario that we introduced during the previous forecasting round. So that was the baseline scenario, and quickly I will compare it to the previous forecast, although it's quite clear what are the changes in the forecast. To indeed summarize quickly what is the difference for the foreign outlook, then it means it's more stagflationary scenario in the Eurozone, indeed meaning that there is higher inflation in the Eurozone and lower economic growth compared to the spring forecast. That somehow influences also the forecast of the domestic economy. And it means that there is indeed significantly higher forecast of the overall inflation. It's related to all the components. All the subcomponents of the headline inflation are revised towards higher values. Again, I would like to highlight here, it's mainly the core component and the regulated prices where the revision was significant. Regarding GDP growth for this year, it's a bit higher compared to the previous forecast, but that's just the reflection of relatively good condition in the domestic economy at the beginning of this year, when the growth was higher than we expected last time. But for the next year, 2023, the weak domestic demand means that we revised the GDP growth for the next year to be lower. In case of nominal wages, the forecast is slightly higher, but it's really the nominal term, so reflecting higher forecast of the inflation. There is a higher nominal wage growth. Indeed, finally, the impact on the real wage or the total wage bill, it's slightly, or it's quite similar. So the story is more about the nominal variables. In case of the exchange rate is slightly more depreciated. Indeed, reflecting mainly the starting point, the initial point for the forecast, as the previous forecast expected that the exchange rate will appreciate. This did not happen, and for the outlook of the exchange rate, more to the future, it's mainly the narrower interest rate differential that is pushing for the weaker exchange rate, together with worse BOP situation in the domestic economy compared to the previous forecast. What is maybe more interesting is the comparison of the current trajectory of the nominal interest rates compared to the previous one. So initially, the trajectory is, the current one is lower. Then in the first half of 2023 is just slightly higher. And when we check what are the factors that are contributing to this difference, then we can clearly see that towards higher interest rates, there is a contribution of the foreign economy. So indeed, higher foreign interest rates and higher outlook for the foreign prices that contribute over the whole forecasting horizon. Together with the changes or adjustment or new outlook of the foreign economy, there is also positive contribution to the higher interest rates of the energy prices. So indeed, that's the light blue color. So this is the channel through which the higher energy prices are influencing the costs of the producers. So the second round effect. And together with that, higher energy prices are entering directly also to the consumer basket. So there is a higher outlook of the administrative prices as well. On top of that, we also have a positive contribution of the near-term outlook, so the outlook for the third quarter for the exchange rate, and also for the inflation forecast for the third quarter. In the opposite direction, there is a contribution of the initial state, so the new data that are available, and indeed this new data or the interpretation of the new data brought us to the situation of better effectivity, labor effectivity or productivity that was identified for the first quarter or first half of this year, and indeed better productivity means anti-inflationary pressures and the contribution of this factor to the lower interest rates. Then there are contribution of the expert judgments here for the second half of this year. The contribution is related to the expert judgments that are related to the lower consumption of the households. For 2023, the expert judgments are related to the development of the nominal wages, that we adjusted the nominal wage growth to be a bit lower, not to fully compensate the increase in the inflation that is observed this year. And the last factor that is here is the change in the monetary policy horizon. So it means by shifting the policy horizons to be 2 quarters more to the future, there is no response to the extraordinary inflationary pressures that are identified right now in the domestic economy, and the contribution is to the lower interest rates. And the last part, that is about the policy simulation. So during the preparation of the baseline scenario, indeed one of the most important uncertainty that we identified was the uncertainty about the anchored inflation expectations. So to check what is the implication of the anchoring of the expectations, we prepared this simulation. So there is an assumption that we add to the baseline scenario, so to the scenario with the monetary policy horizon that is in the first half of 2024. So we add there a new or additional assumption that is saying that the inflation expectations are anchored at 5% for the rest of this year and for the next year, and then gradually in 2024 they are declining back to the inflation target. It just simply means that the inflation is higher, and there is stronger response of the monetary policy through the nominal interest rate. So the interest rates are going up to the 10%, and indeed this increase in the interest rates through the interest rate differential will push for the appreciation of the currency. So indeed the tightening of the monetary policy will bring inflation back to the target. The trajectory of the inflation is higher compared to the baseline scenario, and also what is clear, we return to the inflation target at the end of 2024, so just after the monetary policy horizon. Indeed, this scenario, the tighter monetary policy conditions, means that it will finally help to bring the anchored inflation expectations back to the target during 2024. And the last scenario that we prepared for the policymakers, it's indeed the replication of the baseline scenario that we had last time. So here we used, let's say, standard monetary policy horizon, so from 1 to 1.5 year, and we check what is the response of the monetary policy in this case. What does it mean? The monetary policy tries to bring inflation to the inflation target during the monetary policy horizon that is closer to the current situation, so the second half of 2023. And to do that, it's necessary to further increase the interest rates that will help to appreciate also the currency and tighten the monetary policy condition, I mean the overall one. This response also means that the assumption about the anchored inflation expectations in this scenario is somehow supported by this reaction. So that was indeed everything from my side. Maybe I will just add one more point. We also prepared a scenario about a temporal and or permanent halt of the supply of the gas from Russia to the Eurozone. So this, let's say, crisis scenario. about the situation that is somehow likely to happen, and it's discussed. So you can check it. That will be available in 1 week as the extra simulation that is added to the monetary policy report. So that's everything from my side. Thank you.
Mr. Musil, thank you for your presentation, and now we can move into the debate on details you are interested in. I would like to ask you first, you put the question, please introduce yourself and your institution. Thank you. And now it's time for the first question. Please.
Good day. So Martin Paul, General Investments. I have a question related to the choice of the baseline scenario, because the assumption about on longer forecast horizon, it was included last time in the alternative scenario. Could you provide us, more background about the choice to move the alternative scenario to, let's say, to the baseline, and what were, let's say, the main arguments shared by the board that were behind this decision?
Good morning to everyone. I would like to thank all who joined us today this or that way. For me, it was 72nd monetary policy meeting as a board member yesterday. Nevertheless, the previous one was 16 years ago. Still, the yesterday's one was one of the most interesting. The issue of opting between shorter or standard, let's say, and longer horizon was quite important, not only during the yesterday's meeting, but also during the preparatory meetings for monetary policy meeting. The final option requires a pretty complex explanation, so I will provide it to you. I just want to repeat that the board yesterday had not only the baseline scenario with longer horizon, but also some further scenarios and simulations. Some board members opted for would prefer the standard horizon. Majority of the board members opted for a longer horizon, and also staff, I think, would support the standard horizon. But still, all of us had a full set of information. The scenario with longer horizon was prepared for May meeting, and the rationale for doing so was explained by Petr Král, the head of monetary department, during the last version of this seminar. So I would like to ask Petr for just a brief introduction of why it was chosen in May as an alternative scenario. And I will then continue.
Thank you. Yeah, it's absolutely true that we discussed this situation during the spring quarterly macroeconomic projection exercise with the previous bank board already. We were facing the situation where the breakout of the war in Ukraine further accelerated the price increases of energies, materials and commodities, and we identified this situation as a further very strong negative supply side or cost push shock. And in that circumstances, it would be let's say, appropriate from a monetary policy to look more beyond the standard monetary policy horizon, to take on board the fact that such a type of shock, which is long-standing, huge price increases of energies related to housing, will have only distributed effects, or over time distributed effects on domestic consumer prices. And the standard horizon of 12 to 18 months could be, in that circumstances, relatively short to be able to, let's say, abstract for these primary effects. That's why the alternative scenario from the spring monetary forecast, from the monetary spring meeting, was prepared to enable the policymakers to react only on the second round effects of such a huge negative supply side shock, and to abstract from the primary effects. This time the board expressed its view that maybe this is the explanation for the spring exercise round.
Okay, so basically the board changed the reaction function in the forecast for the first time, simply because for the first time we are pretty directly facing economic consequences of the war. Still, there were relatively diverse motivations by different board members for lengthening the horizon, so I will try to explain it in detail. One of the simple motivations was that we definitely do not know whether the economy will have enough gas to produce in the near future, and the probability of such development is somehow increasing. So it was one of the motivations for some board members to somehow wait what happens in a little bit longer horizon. But there were some more fundamental ones. Some board members feel that there are some transmission mechanisms not covered by our core model that are quite important, and that usually have effects over a much longer horizon. I mean, these are channels affecting the economy through asset prices, credit, and indebtedness, and so on. So that is one set of motivations. Some board members feel that having a little bit longer horizon may compensate for the fact that our standard reaction function of the central bank has only inflation gap in it. For very good technical reasons, still some board members think that if we had, for example, in the past, output gap or some approximation of overheating of labor market in the reaction function, we would have tougher policy over after 2017, for example. So that is a little bit long-term debate on what should be and what should not be in the reaction function, and some board members may feel that looking through the longer horizon could somehow compensate for it. I understand that looking at the responses by analysts or commentators yesterday, that the decision to lengthen the horizon is viewed as a way to arrive in lower rates, but don't live just in the current situation. Some board members view this approach as something that would deliver tougher monetary policy conditions in the periods when inflation was rather low. And some also feel that removing some short-termism is desirable, which would mean that once the inflation comes down, and it can come down quite abruptly, as we remember, the longer horizon would not require such aggressive reaction in going down with rates to a very low level. I personally do not think that it's a big issue whether we have a shorter or longer horizon, because our core model is structurally quite simple, and there is not much beyond uncovered interest rate parity as a key difference. So clearly, if we use in the situation we are facing now, shorter horizon, there is more aggressive interest rate reaction at the beginning, and through interest rate parity, it delivers stronger currency and faster disinflation in the model. So for given forecast at a given time, it is like this. Next time we start from the scratch again. So that's a normal and simple description of the difference between the two approaches. So that's, I think, that's somehow complex, and the explanation why we opted for, why the majority of the board opted for a bit longer horizon. I would also say that we had discussion whether 6 quarters is too much or not. So some board members were saying that 5 quarters would be much better. So we will think about it throughout the time.
Thank you. Next question, please.
Good morning, Jaromír Getz from Komerční banka. Actually, I have 2 questions. My first question is about the labor market and the wage growth. I dare to say that there's no significant cooling of the labor market in your latest forecast. We see employment to continue to grow. We see only slight increase in the unemployment rate. But at the same time, you see the wage pressures to be rather muted, in my view, as we see real wages to drop by more than 12% this year and 3% next year. And especially when I look to the productivity, you expect it to grow by 1.1% this year and 0.4% the next year. So could you please explain in more detail what you think will dampen the wage pressures, especially in the next year? And my second question is about the FX outlook. You expect the koruna to depreciate almost to 26 koruna per euro in your forecast. At the same time, you call it slight depreciation. And yesterday it was said that CNB is ready to continue to prevent an excessive fluctuations of the currency. So how should we take your trajectory in the forecast? Is the depreciation outlined in your forecast an excessive fluctuation, or is it a trajectory you would be happy with? I mean, I'm asking with relation to your FX interventions, of course. Thank you.
Okay, maybe I would, Petr Král would start with the first question, and then I will continue. Of course, Petr can say anything also on the second question, so please.
As Karel was describing during his presentation, the nominal wage growth during next year will reflect basically 2 things, or 3 things. The first one is that the tightness of the labor market is going gradually downwards, and we have seen it especially in the real side of the labor market in recent months and quarters. And for the future, we really expect that unemployment rate will gradually increase, and the employment growth will continue, but will be the vacancies will be primarily covered by refugees from Ukraine, which is also having a dampening effect on the nominal wage growth. The second important underlying factor is that we expect only partial backward compensation or indexation for inflation from this year in the development of nominal wage growth in business sector in the coming 2 years. That's why we can expect that the real that the real wages will decline even during 2023. Despite the nominal wage dynamics will get relatively significantly above the long-term trend. And the third underlying scenario in the baseline is that inflation expectations are still very well anchored, close to 2% inflation target, which means that it prevents possible wage price spiral from materializing. That's why we can expect relatively muted nominal wage growth in the forecast.
As to the board, we take the labor market developments rather seriously, and the labor market risk is clearly the motivation behind tightening bias we have in our communication. So over the years, we were somehow quite often surprised by the ability of the labor market to stay pretty tight. And similarly to this, if we see signals of spiraling between inflation and wages, it would be a strong signal for further monetary conditions tightening. So this is just I contribute to what Petr was saying. As to the forecast of exchange rate, I will start maybe back to in my previous life. For 15 years, I was the head of financial stability, and in our financial stability reports, we were often presenting something which we call forecast. I was always quite cautious in labeling that forecast. So quite often these were projections and sometimes some even more technical assumptions. And I think it's similar for FX forecast. So let us say for me, it is the forecast of exchange rate is somehow technical projection, I would say, obtained mainly through uncovered interest rate parity. And I always recommend students that unless they really believe that FX rate follows closely uncovered interest rate parity, they should look quite cautious at forecasts. So I would approach the forecast this way. There's a lot of uncertainty, and as I say, these differences in forecast pretty much reflect just UIP, and it is more technical, let's say, projection than true forecast. And so you should consider also this in thinking about interventions.
Thank you. Next question, please.
Jakub Seiler, Czech Banking Association. Speaking about this FX forecast, I just wanted to ask, what is, maybe this is more for expert, what is the FX pass-through assumption right now, whether it did not change now with the energy situation to maybe a little bit higher figures, because now it might be more important to CPI development. So how does it look like? Thank you.
The exchange rate pass-through and the pass-through of the foreign price indices into the domestic price development haven't been changed in any way compared to the previous setting of our core projection model. As Karel was mentioning during his presentation, we properly account for both direct and indirect effects of global energy prices to domestic price indices via inputs for domestic industrial production, via direct influence on regulated price segment, which is heating, electricity and natural gas for households. And from this point of view, we are persuaded that we accounted or we took everything on board in a standard way, and we didn't change the intensity of the exchange rate pass-through in any way.
Next question.
Martin Janíčko, MND. Thanks for the presentation. Just 3 questions. I noted significant revisions to the previous forecast in terms of the inflation especially. Could you maybe summarize what are the main changes compared to the previous, let's say, assumptions that changed inflation so much? That's one thing. Obviously, FX was already discussed here, so I don't have to come back to that. Second question is about increasing employment. So you expect that employment goes up, but household consumption goes down quite a bit. My understanding is that the effects of inflation prevail, or are more important than the effects of increasing employment on the consumption. So if you can confirm that. And the third question is about the alternative scenario. Is it the case that the COVID-19 scenarios have been dismissed already, or are you expecting COVID to come back at some point and maybe still have some say in the economy or have some effects on the economy? Thank you.
As for the inflation forecast change, the composition, it is really a broad-based kind of thing. Almost all factors have been pushing the outlook for inflation upwards. It stems from the initial state. Inflation for the second quarter of this year was persistently surprising us on the upside. We have seen a weaker exchange rate compared to the previous forecast. We have had a higher outlook for foreign energy, even non-energy prices. We have unfortunately much more pronounced increase in a regulated price segment in the months to come. And all this is pushing the inflation outlook upwards, and this revision relates to all components across the consumer basket. As for your second question, I can confirm your intuition. The effect of higher inflation pushing down the real purchasing power of domestic households is playing much more important role. And as for the COVID assumptions of the forecast, this baseline scenario and the other scenarios as well do not expect any anti-pandemic measures having any material impact on the domestic economic activity.
Jaromír Šindel, Citibank, thank you. I would like to ask you, because there was labor market was mentioned as something like a key important factor for the future monetary policy decision. And if I look at your market or the nominal wage growth in the market sector for the second quarter, your forecast is something like 3% year-on-year, if I'm right, in the second quarter. But if I look at the industrial construction data, it suggests 8.6% growth. So maybe, I'm not saying that your forecast is wrong here, but if the wage growth surprise on the upside in the market sector in the second quarter, what would be the implication for the monetary policy? if I'm right, because I look just very quickly at the forecast, we have 2.9, I think, in the market sector. Yeah, but the industrial wage growth, construction wage growth is very strong in second quarter. Yeah, so my question is, if this industrial wage growth is something like a good leading indicator for the second quarter, what would be the reaction of the monetary policy? Thank you.
You are referring to the correct figures from our forecast regarding the nominal wage growth in the second quarter of this year, but this is the estimate of the officially published nominal wage growth, and besides that we have been for a certain period of time computing so-called fundamental wage, which is abstracting from one-off statistical effects, and fundamental wage growth for this second quarter is 6.4% in our forecast, which is quite solid nominal wage growth still.
Thank you. Thank you.
I just repeat that if we see indication of spiraling between wages and inflation or vice versa, so it will be an important factor for our decision making.
And if I can have a second question, it is about the comparison of this alternative on baseline or baseline and alternative scenario. If I look at this page 20, where you're comparing these scenarios, I see 6-month PRIBOR by roughly 3 percentage points higher than in the baseline scenario. I see the currency stronger in this alternative scenario by some, let's say, 3%, but the difference in the CPI growth is something like 0.5 percentage points. Yeah? So what is the message for the bank board? Because if I look at this, it tells me monetary policy doesn't work for inflation. Yeah, because it doesn't matter too much for the inflation if we have such a big difference in the assumptions, how the monetary policy should be, and we have negligible impact on the inflation growth. Yeah, so how the bank board looking at this? Thank you.
Maybe I'll start with a technical note. You have to take into account that we are not capable or able to prepare 3 fully-fledged scenarios to be comparable in all details. This would be far outside our personal capacities. When preparing full-fledged baseline scenario, we, in the final process of deriving it, we incorporate many tunes, expert judgments, and fixes to take on board expert views on sectoral experts from our department, from managers, and also from the bank board. This was done this time for the baseline. It is used to be done for all previous baselines, but this is not fully done in those alternative monetary policy simulations this time and in the spring forecast round. That's why the difference between alternative scenario, monetary policy simulation, and the baseline scenario is not only the monetary policy horizon, but also the final refinements are somewhat different, and the expert judgments are not the same, because the expert judgments are scenario specific. And as this is not the fully fledged baseline scenario, this is not completely comparable. But as I see it, it offers some illustration of the situation that the current policymakers are facing.
Would you like to add anything, Mr. Floyd?
Maybe I would just add that, of course, we discussed the capacity of interest rate channel to secure lower inflation if rates go up in a reasonable short horizon, and definitely we see that the strength of interest rate channel is somehow reduced by globally and locally declining long rates, and also significant share of FX loans in the corporate sector. So the higher rates would definitely impact on just part of non-financial corporates that are funded through Corona loans, and our view is that the rates especially on short-term credit for non-financial corporates are pretty high at this time. So we were taking that as one argument for a pretty cautious approach.
Next question.
So good afternoon, Petr Dufek from Creditas. I have one remark to your alternative scenario, because it looks like high inflation expectations as well as high interest rates are resulting in a huge support of the GDP. It's quite strange for me, but that's only a remark. I would like to ask you, how do you measure inflation expectations? Because this is a precondition. Inflation expectation up to 5%. So where can I find this figure in the statistical office or in the ARAT database or somewhere else? And the second question is for Mr. Musil. You were talking about administrative prices or regulated prices, but only a small part of the energy prices are in fact regulated, only the transmission. And therefore, I would like to ask you if you include in these figures as a regulated prices all the numbers, all the prices of the energy, it means electricity and gas. Thank you.
As for the measuring of inflation expectations, it's a quite difficult kind of thing. Inflation expectations really matter. It is a very important factor for macroeconomic development, especially and especially for monetary policy decision-making and forecasting. But we don't have a solid measurement of inflation expectations at our disposal. There is no statistical time series produced by the statistical office which would be representing directly the underlying inflation expectations and revealed inflation expectations in the economy. That's why we have been conducting a battery of analyses using surveys, using other sources of information, and using structural and empirical models to be able to come up with a conclusion whether or not inflation expectations are still consistent with our 2% inflation target in the medium term and in the long term. And what is the outcome of our analysis so far is that there is a risk that inflation expectations could become unanchored, but this is only in a kind of risk mode, and that's why we decided not to change the assumption of the baseline scenario in which inflation expectations are still anchored at 2% inflation target in the medium and long term. But in this alternative scenario, we challenged this assumption by saying that what would be the outcome for economy and monetary policy if we are wrong in this very important assumption, and we took this 5% level of inflation expectation in an arbitrary way, and the results of the simulations are saying, yes, if this is the case, monetary policy would fight inflation and inflation expectations in a more aggressive way to bring inflation back to a 2% inflation target at the end of forecasting horizon, because those inflation expectations are at the very end of the forecast horizon against the let's say spontaneous decrease of inflation back to the target. This is the, let's say, illustrative simulation. We have been doing our best to present and further analyses on this topic for the board and possibly for the public in the near future.
And regarding the deregulated prices, or I should be correct, administrative prices, indeed the calculation is done really in a way that we split or divide the deregulated prices and the rest that of the prices, and try to calculate or forecast these two components. Indeed, we are doing that at really the level of the individual providers of the gas, electricity, all these components. We indeed cross-check the price lists of the providers that are included in the consumer basket, and try to calculate it in this way. So I believe that we consider this or include this approach or the way of the calculation in a proper way, as it is done by the statistical office.
And by the way, the prices of natural gas on commodity exchanges are expected to rise further during the rest of this year, which is reflected in our forecast of natural gas prices for households and electricity and heating for households, as we expect that domestic providers will transmit those world prices to the domestic prices for the clients.
Thank you.
Menčič, the Czech Chamber of Commerce. I have only one question. What do you think about possible effects of planned fiscal policy? I mean, possible imposing of taxes on banks. Thank you so much.
Well, our assumption is that the fiscal policy is about to be relatively neutral. So that's what I would say just for today. Maybe colleagues may add something, but I think this is what we work with.
Dear colleagues, I consider the time is quite running. Is anybody wishing to put the last but not least question?
Okay, so maybe I misunderstood your question. As to the windfall tax, it is a political issue, and we won't comment on this generally. We had Minister of Finance yesterday, but we didn't have room to discuss that. What we were just saying over last couple of days, that those who are interested in projections of banking sector profit for this and next year should first look at our financial stability report from June. That is providing such forecasts. The true profit for 2022 could be a little bit higher, but not much. So that's what I would convey to this question.
I'm sorry if I can make the last questions about FX intervention. What would be the trigger for the bank board members to stop the FX intervention?
Okay. The current board is a perfect representation of economists' universe as to the FX issues. Some board members do prefer strongly floats, not because they are good, but because they are less worse than fixed. Some board members assume that fixed rates have stabilizing effects. Some board members view FX interventions as a normal standard approach to monetary policy, while some board members view it as a non-conventional tool. So we have ongoing, frequent, and regular exchange of views on FX interventions, and there is one agreement that we will get out of it once it is not needed. unfortunately, we don't have agreement on the definition. It is not needed anymore. So that's what I would say for today.
So I think the FX interventions was the nice last point of our meeting. If it's not any question, I would like to thank you all for joining us, and I would like to thank all speakers to present their opinions on the new macroeconomic forecast and the detail of that. And let me just tell the last word. The presentation you saw today is already published on the CNB website, and the monetary policy report will be published next Friday. Thank you and goodbye.